Hello and welcome to Crux Investor. We caught up earlier today with Sandeep Singh. He's the president and CEO of Osisko Gold Royalties. And we talked to him about learning from the past and a pure play royalty strategy going forward, and perhaps letting the portfolio do the heavy lifting. If you want our thoughts and opinions on that conversation, the topics discussed, Sandeep himself, and indeed the company, you can find that at cruxinvestor.com/club, where you can also find detailed company reports and analysis. There's commentary from experts from around the world on a variety of companies and commodities, including royalties. We've got training courses on there to help you with your diligence process. We've got summaries of other interviews that we've done just to save you some time. In fact, all of our interviews to save you some time, because we know you're busy people. And if you want to join a thriving community of investors sharing their thoughts and ideas with each other in a nice, friendly and safe environment, free from judgment, trolling and abuse, join them at cruxinvestor.com/club. I think you'll really like it. And we'd love your feedback too. So do give us a like, be appreciated. Leave your thoughts below. We'll get back to absolutely everyone. And if you want to see precisely what we talked about today with Sandeep, do take a look in the description below. Sandeep, how are you, sir?
I'm good, Matt. How are you?
I am magnificent. Had a great weekend, and the sun is out. The spring is here. It's all good.
Yeah, people are feeling a little bit better. Hopefully, the path is clearer here in front of us.
Yeah, the path is clear to that beach behind you. That's where I hope the path is clear to.
Yeah, nice. That's clearly a pre-COVID scene, and using it as inspiration.
It's like that feng shui moment. You have around offices.
Trying to will it into existence.
Yeah, it'll happen. We'll get there. Hey, so how's life with you? You've been busy?
Yeah, always busy. We've been busy as a company. Obviously, everyone has been a lot more interest in gold and precious metals last year, and so we were busy in that vein, and obviously busy as a company with a fair bit of things we needed to do strategically, which was the focus for us last year. So it's been good, busy, and happy with how things are going at the company.
Turnaround year. Is that what it was?
A reset year. 2020 was a reset year. Yeah. No, we had a kind of inward facing. We had some things to do internally to finish a transaction that we had started in the fall of 2019, and feel like we created a lot of value. Not only feel like we created a lot of value. It's on the tape. You can look at it. But that was a key part of 2020 for us. We were also reshaping the team, which I was part of, coming in as president in January of 2020, and then taking over the CEO role from Sean and later in the year. So it was a busy year.
Cool.
Is a quick way to summarize it.
Okay, well, let's talk about reset year in a second. But first of all, give us that 1 minute overview of what your business is, and I'll pick up from there.
Sure. We are Osisko Gold Royalties, traded in Toronto and the NYSE under the ticker OR. Currently the fourth largest precious metal royalty company in the space, with a roughly $2 billion US market cap, 17 producing assets currently that underpin our guidance of the midpoint of our guidance, which is 80,000 ounces of GEOs, gold equivalent ounces. That's how we refer to our production. Importantly, that's production in largely the Americas, North America, the Americas, with strong operating partners, some of the best in the sector. And a lot of growth that we paid for in a down market. A lot of growth that we paid for in the last, the years preceding 2020, when gold was $1,200 to $1,300 an ounce. It's now kind of coming into our portfolio. So good production, diversified, in good jurisdictions, a lot of growth on the come, and quite liquid as a royalty company, or as a company. We trade a lot of shares on a relative basis to our peers. And all that, I think we provide one of the cheapest entry points into the royalty space.
Cool. Okay. Well, let's talk about that. So we've had a lot of questions sent in, a lot of thoughts about Osisko. Certainly one of the better known, for sure. You've had people know your company. That's always a good start. But it's kind of like you get a mixed review. The basic sentiment seems to be mining company, thinks they're quite clever, becomes a royalty company, becomes a private equity company, wants to be a royalty company again. Mixed messages. Market doesn't quite understand what's going on. What's your version? Well,
I'd say all that's fair, or at least the confusion is fair. I think we brought maybe some of that upon ourselves in the fall of 2019 with the transaction. Transaction, for those who are not familiar with it, was the acquisition of Barkerville. And so, confusion, yes, but I think we're getting out of that. We have never wanted to be, as Osisko Gold Royalties, anything but a royalty company. We've taken a slightly different tack, because when you think back to when this company was spun out of Osisko One, if you will, which built, this team built, became Larctic Mine, sold it in 2014. I was actually an advisor to the company on that hostile defense and sale to Agnico and Yamana. At the time, it was one producing asset, a basket of 5 in total, still competing with a pretty competitive group at the time. Franco, Wheaton, Royal, they all still existed. So to build a portfolio, the tack was we were going to have to be a little bit different. And that's how this company was built, how the accelerator model came to be, how competing on price alone was not going to be the way to build a company, or at least a sustainable way to build a company. So that's kind of our past. And I think that history of having been an operator, now a royalty company, obviously that's some of what you're alluding to. With the transaction with Barkerville, again, it was a pretty simple thesis that at the time, almost 5 million ounces of gold, an hour's flight outside of British Columbia, outside of Vancouver, mattered. It wasn't getting traction in the market. Not very many development stories were, if you recall. It was 180 degrees from where we've been of late. So to bring it in, cost us 220 million roughly in Canadian dollars in equity. And we lost a lot of ground, obviously, from a market cap perspective. But that thesis of 5 million ounces, now 6 million ounces in good jurisdiction mattering, that proved itself almost immediately. The gold price certainly was at our backs. We bought it at kind of $1,400 gold. We spun it back out at obviously, it's been sliding downwards, but it was probably still $1,800 to $1,900 gold when we had that transaction. So a lot of value created. And we feel like we've put ourselves back into that royalty lane. So in the end, did exactly what we said we were going to do. Had the right assets, needed to find the right vehicles for them, and put Barkerville into an entity, the Osisko Development Corp, run by Sean Ruzin, our founder, where we created value, and it will end up owning less and less of something that we think is going to be increasingly more valuable.
Right. You put yourself back in the right lane, but the market doesn't necessarily agree with you. You've been fairly flat for the last year. So is this a question of the boat is turning, but just slowly?
I think the boat's turned. I think we haven't gotten credit for it yet, and that's fair. When you think back to 2020, we missed very clearly the run in the first half of the year. I mean, our peers were all outpacing us significantly. Mind you, we still ended up being the second best performing royalty company over the course of 2020. And that was unfortunately by virtue of standing still in the second half of the year while all our peers came kind of not crumbling is the wrong word, but coming back down pretty sharply. So all the things being equal, I'd say that's a win, ending up second in a reset year. But we created that value. We certainly haven't seen it yet. I'd say shareholders get it. I'd remind you that we announced that transaction in October, closed it in December. Basically, the simplification of the royalty business, the separation of church and state, as we call it, all of that into a down market. Despite that, Sean at Osisko Development was able to raise $250 million in aggregate to fund that business, to advance it and create value for us, which is no small feat. And there's been a lot of positive catalysts on the Osisko royalty side as well. So I think we're set up. And certainly think there's a lot of value to go get, and hopefully in a slightly better gold backdrop, we'll be able to go get it. Yeah,
I mean, I hope the market does pick up. I guess there's a little bit of the precious metal market has fallen away, and it's not a case of last man standing wins, because that's not brilliant for shareholders. So tell me more about the things that you are implementing or have implemented that people should be paying attention to, which is going to turn this boat around in 2021.
Sure. And maybe just quickly on your point there. I mean, yeah, momentum matters in all facets of life, and the gold sector is no different. So I think we are facing that. But I think even there, as a royalty company, we can work in all parts of the cycle. So just before I answer your question, I mean, if things continue to kind of stagnate from a gold price perspective, which they could for a little while, we'll be able to do more transactions, or we'll be able to do better transactions. We'll be able to deploy better capital out there, get better deals. When things turn back around, we have a lot of production that benefits from it, a lot of development assets that people are progressing that benefit from a better gold price environment. So we think we have a model that works in all sides of the cycle. In terms of your specific question, what are we doing? What have we done? Again, our baseline's kind of been set. Our investments were done in a down market, so now we're benefiting from them. So a lot of what's happening to us from a positive catalyst perspective is what our operating partners are doing. So we've had some tremendous catalysts, and we'll continue to. We start the year. I guess it's end of March now, so it's not the start of the year, but we're at the point of our life cycle where I can genuinely say to you that our top three, our most valuable producing royalties, our top three producing royalties, all get better this year. One is Canadian Malartic, where I'm sure you've followed the underground story there of Agnico and Yamana. They've announced that construction decision. That's at least a doubling of the life and beyond. We had a flagship asset that was coming off at the end of this decade. It's now been pushed off to 2039 plus, with a lot of upside left in the current resource and in that land package. So that is a massive catalyst for us. It was already the highest value royalty in the entire sector, just based on the open pit, and it's just essentially doubled in value. So that's, I don't think there's any other royalty company that can say that their flagship asset has gotten twice as good this year. If you look at assets like Eagle for us in the Yukon, which is run by Victoria Gold, they commissioned themselves last year. They're going through ramp up and have guided towards a pretty significant uplift for us, almost a doubling of ounces versus what we got from them last year. Mantos is another one where we had all the silver off that mine in Chile. They're going through an expansion that will tie in at the end of this year, and our ounces will grow pretty significantly off the back of that. So that's at the top of the ledger. If you work all the way down, our producing assets are generally outperforming. We're getting a lot of money spent on our grounds and a lot of positive catalysts, mine life replacement, mine extensions, mine expansions, and new discoveries kind of throughout the portfolio wherever you look.
You mentioned something earlier which I want to come back on, which was the thesis around Barkerville at the time. Were you part of that decision-making process?
I was as an advisor. And I guess, what I'd say, and just to take a step back, for some that don't know me, don't know the company, new to the role, but not new to the company is the way I describe myself. So I've been advising the Osisko group of companies for the last 15 years of my mining banking career, helped Sean finance Malartic build, help him on defense, as I mentioned earlier. And I've been behind the scenes and putting most of the assets into this company since it was spun out. It was IPO'd in 2014 for good and bad. So I can't disassociate myself from any of it. And again, the logic was sound. More of a shock to the shoulder base than I think any of us expected. You'll have to remember that at the time, everyone in the royalty space was doing we're doing different things for growth. There weren't a lot of transactions being announced at that point in the cycle. Franco was doing oil and gas deals for growth. Wheaton had gone into cobalt. Royal Gold had gone into copper in Botswana. So everyone was looking to add growth in different ways. Sandstorm had picked up Hot Maiden years prior. For us, a small transaction relative to our size in Canada for a large asset that we said we were going to turn into something that fit our model. We didn't think it was too big of a departure. But again, you can't fight City Hall. The messaging could have been better. And ultimately, we reacted to what our shareholders wanted us to do, and we created value. We didn't exaggerate. We took our time, owned it for less than a year, and a year later, I think we're far better off than we were at that point in time from a value perspective.
I'm just intrigued about what you've learned. You're a relatively young guy, okay? And I get you're rated on the street, as a financier and so forth, and you've been involved with the company in one way, shape, or form for a long time. But and also I appreciate you may not have been driving the bus, but you're part of that discussion. So your takeaways personally are what? Stick with the knitting, or just time it right? You talk about better communication. It can't be just about better communication. It could be more fundamental than that.
Partly, it is more fundamental than that. So I don't want to kind of dismiss it. I think it's fair to say that simplicity matters in the royalty sector, especially. It probably does everywhere, but especially in the royalty sector, it matters. So, and I'll say this now, having been marketing the company for a year and a half, or almost, we like to think that there's all this value and that people should take the time to focus on it and do the work to figure it out. But the world just doesn't work that way. There's not enough hours in the day. If you describe yourself or you portray yourself as something that people find confusing, even if you don't, it's easy to move on to something else. And that's what we found in the first half of last year, was at the time when all that money was coming into the sector maybe for the first time, we looked too complex. People didn't know what to make of us, and so they moved on past. I think we laid a lot of good groundwork with those same people last year. We did exactly what we said we were going to do. And hopefully when that money comes back into the sector, we'll be able to get a disproportionate share of it.
It's interesting. We spoke with Sandstorm recently, and they had a similar scenario. They did a deal in Turkey that people didn't understand the structure thereof. It got confused, and I think it hit them for six. Or sorry, it's a British phrase here. It hurt them. Let me put it like that.
No, right? I understood the cricket term.
Okay, big fan. So we spoke to them and we tried to sort of get under the hood there a bit and sort of understand why they did it, and they've had to kind of slightly backtrack that thing, and it's harmed them a little bit in terms of valuation for sure. But you think if you start talking the language of pure play, people will forgive you with a bit of time, and obviously start seeing some of these cash flows coming in. So that's what's key here, is the cash flow to the business. You think that you can move past this and on to a situation where perhaps one, share price recovers, but two, you're able to go and do more deals and people support you?
I absolutely think so. I mean, I think that's already happening. Our shareholder base gets it. We obviously had some churn. Some people that didn't buy into the transaction left immediately. They left in a disorganized fashion. It caused quite a bit of a headwind. But we rebuilt that over the course of last year. And I feel like we absolutely have rebuilt it. The shareholders that are in the company now, they get it. They understand the value proposition. They know where we can get to without frankly doing too much. I mean, we don't have to do too much right. There's a lot of things we can do a little bit better, but the portfolio is real. It matters. These are not also ran assets that are being slapped together at the high point in the market. These are assets that were carefully selected in good jurisdictions in the downturn, as well as our growth that can basically double our size of company over the next several years. All that's still with good operators in good jurisdictions. So this asset base matters. I absolutely think we'll get value from it, and I don't think we're that far from it. I think as I said, a lot of good work was done with new investors last year. If they go back and look at what we said we were going to do, I think you'll find a lot of tick marks on that page. So I'm hoping that we'll be able to convert those into new shareholders and get the value of the company where it belongs.
Right. Okay. Well, let's start talking about the portfolio then. So what is the size of the portfolio? You mentioned a few which are significantly advanced, but what's that profile look like across the rest of that portfolio?
Right. So as I said earlier, 17 producing assets currently. There'll be another couple that start to come into the fold this year, next year, out of a basket of about 150 right now. Obviously, not all of those are hugely significant. There'll be a lot of kind of early stage exploration assets that people may or may not be working on, but 17 producing, another kind of similar set that are in the development space that are all kind of moving forward, or most of them are moving forward, and frankly moving forward faster than they have. One of the knocks on us, if you will, has been that if you looked at our development pipeline a few years ago, it looked a little early stage, which is normal when you think of the life cycle of our company. We're only 7 years old today, basically, so it takes time for the investments that you make to mature. But now they're coming into their own in a very conducive gold market, very conducive equity market, where those companies are being able to raise the equity components of their build. So that's a good news story for us that will continue to evolve. So diversified production today from a significant number of sources, a lot of growth coming online without us spending a dime on it. And as well, behind that, there's a lot of good exploration portfolios. I mean, the depth of this company and its portfolio is significant. There are names out there that people are spending $30, $40, $50 million to acquire baskets of early stage assets. We look at the back of our cupboard and we think we have better assets that we don't talk about on a regular basis just because there's no time to. So there's a lot of depth to this portfolio, and I think that will play out in the year to come as well. Okay,
so I'm going to ask a little bit of detail here.
Sure. Okay.
I'll forgive you if you don't have the numbers to hand, but it'd be useful. What is the gold equivalent royalty linked resource or reserve numbers that you've got?
I don't have the number offhand, but it's significant, and it is on our website. I think the reason why I don't have it is because it is so big. I mean, there's our producing assets, and all we have some pretty chunky development assets, some of which are not in a straight line to production, but they're there and they're real and they're being pushed forward by real assets. So I don't try to throw a total resource number at people, because it can sometimes be misleading if those assets are not moving forward.
Let's ask it another way. You've got 17 cash flowing, but this year, how many? Right. Okay, so how many stock exchange compliant 43101s, or JORC if you've got Aussie stuff, reserve or resource estimates directly on royalty claims?
Well, let me put it to you this way. So of those 17 producing royalties, only one of them would not be in a public company with a 43101 report. The one that isn't is that Mantos asset I mentioned in Chile. It's an ex-Anglo-American mine being run by an ex-Anglo-American team. It's a high value copper asset. That's one of the bigger prizes in the private equity space. So if you're asking, there's high level of disclosure on our core assets, not only our producing assets, but also our development assets.
Well, let's talk about the development assets. I guess 17, I get it. You're telling me they're cash flowing, so that's easy, right? We'll look in your presentation and work out what that number looks like. What about the development components? How many of those are coming through in the next 2 years to production?
So that's the important part of the story. I mean, if you look, honestly, I think we're undervalued if you just look at our producing assets. So if you look at a price to cash flow multiple right now, we're at the bottom end just based on our producing assets. We have, depending on who you look at, a 50 to 55% weighting of NAV to development assets. The large three in our peer group are all benefiting from 90% of their values kind of coming from their producing assets. So they're benefiting from most of their portfolio. Our weighting is about 50-50 production development. And again, that makes sense when you think about our history. We're a relatively new company. We're building a portfolio as one does. You end up disproportionately investing in development assets. Those are the folks that need your money the most, right? So that's what we were doing, building out our portfolio. Now that portfolio is that natural transition from development to production is happening. And you, as a royalty company, we really only benefit from our ounces fully, no surprise, when they're producing. So that's a pretty important facet of the company going forward. To your question, I think you phrased it as how many and who. Look, we think we have some of the best development stories out there. I mean, we have exposure to Osisko development, obviously, which is the Barkerville camp and the San Antonio asset in Mexico. Osisko Mining, one of our other sister companies, is pushing forward the Windfall asset, which is 6 million ounces in all categories of high grade in Quebec. We've got NSRs on a South 32 asset, which is one of the best polymetallic development projects in Arizona in the world. So there are significant assets coming along the pipe. The ability to add, 5,000 and 10,000 ounces of annual GEOs to our production profile. So we'll have growth this year. We'll have growth next year when the Mantos project kicks in. And then really in 2023 and 2024, we've got some very chunky assets that are coming into the pipeline as well. So the good news is growth every year for the foreseeable future.
But can you give me some sense of what that growth looks like in numbers in the next 2 years?
Yeah, look, I mean, that's one of the challenges with being a royalty company. It's not our disclosure. So when there's no timelines associated with it, it gets tougher. But I'll say this, 80,000 ounces is our midpoint for this year. Next year, we've got an additional 6,000 GEOs coming from Mantos, basically at full production. So that's a pretty big lift next year. Over the span of this year and next year, we also have assets like Mineral Alamos' Santana mine and First Majestic's Ermitaño. Each of them are 1,000 ounce a year contributors, which is not massive, but we'll take it. Those are pretty nice contributions. So that's kind of the very near term. Behind that, we've got production from San Antonio, which is the asset, one of the assets Sean is pushing forward in Mexico. That can give us, based on their guidance, 9,000 ounces a year of production. Somewhere between 2023 and 2024. It's permitting dependent in Mexico. Obviously, things have hit a bit of a backlog in Mexico due to COVID, but that's just kind of process. You look at assets like Barkerville and Windfall, or Barkerville, let's start with that. That's another 9,000 to 10,000 ounces a year. Probably can hit some of 2023, but more significantly in 2024. Windfall, similar story with about 6,000 ounces there. So those are chunky assets, all well financed, all being pushed forward. It's never as fast as you like, but we'll take it. And frankly, it's not that far away either.
Right. So have you got a sense, or I don't know how you measure these things, but how many meters are being drilled across all of those projects?
We do, and we do track it. And that's another important facet of the company. So in 2017, 18, and 19, we had 1 million meters a year drilled on our royalty grounds that our shareholders didn't pay for. In 2019, it's important to point out that more than half of that was on our producing ground. So where the impact of any new ounces is more immediate, more impactful. We're still summing that up, tallying it all for 2020 based on the last few outputs that are coming out. And we expect that number to have grown in 2020. Based on guidance that we've seen so far, we expect it to grow again in 2021. So pretty important facet of the company. Our grounds, especially in Canada, you'd imagine they're big prospective land packages in good jurisdictions. They're always going to get that exploration dollar. So we've always had it, but we expect it to intensify in the years to come as miners are looking to stay true to that free cash flow mantra that they've been on. And if you want to stay true to that, the best place you can invest dollars is on your existing asset base.
So what's the number per year going forward? Is it $1 million roughly per year?
Well, it depends on our partners. Obviously,
Sure.
We're not drilling it, but I'd expect it to be higher than 1 million meters. I mean, we got 1 million meters drilled in 2019. If you're looking around, there's hardly any drill rigs to find, and our assets are getting a lot of work done on them. A few examples. I mean, the Malartic story is growing in leaps and bounds. This year alone, East Goldie, which is the high grade portion of that mine, where 70% of the ounces from the underground are derived. We have a 5% royalty on it. This year alone, they're putting 80% of the drilling that's gone into it historically. So almost doubling the amount of drilling that's gone into that asset historically in 1 year alone. Alamos Gold, we have a royalty on the Island Mine in Ontario. They grew resources when reserves and resources grew reserves by 8%, resources by 40% when they last came out with their numbers in February, I believe it was, or maybe it was March. And they've put in a plan into place to spend about 25 million US, if I remember correctly, on that asset just this year. So a lot of drilling on our ground. And I think one of the things to point out, Matt, is, as a royalty company, that's really the torque of a royalty company. That's why some of our peers can trade at the multiples they have historically. Is there's always an asset coming along that's getting better. There's always a mine life that's being extended. There's always a new discovery somewhere. And we really haven't had the benefit of that as a royalty company, being so new. When you take on new exposure to an asset, you basically pay for some version of what that asset is, right? Some negotiated version of what that asset is. And only thereafter, as time passes and more work is done on that ground, do we benefit disproportionately as a royalty company, because we don't have any defining costs or extraction costs after we've put on our exposure. And so we're now into the phase of our company being a little bit more mature, being more advanced than we have been in the past, that we're getting the benefit of that, and we're seeing it across the board in our portfolio.
So talking of keeping the message simple, which is what you want to do, you want to make it simpler for people to understand the story. Are you going to be doing many new deals this year, or is it time to just sit back and see what your portfolio can do for you?
Well, the good news is we don't have to. The good news is we can afford to be disciplined, I think, more than anybody else in the sector, for a variety of reasons. One is we deserve a better fate, we think, in our minds at least. So we're going to focus on getting the value out of our existing portfolio. Second, we've invested in growth, and you can argue we had to because we were a new company, or we got lucky, or we chose to. But we've invested in growth. Prior to 2020, those 3 years prior, we invested more in the royalties sector than anybody else in the entire peer group, including our much larger peers. So we've kind of spring-loaded ourselves for growth, and we did that in $1,200 to $1,300 gold price environment. We're also a size of company at 80,000 ounces of annual GEOs, $2 billion US market cap, where we don't need to do massive deals to show growth. We have a lot of growth. We can double the size of our company by doing nothing. We can incrementally add nice exposure without having to break the bank. So discipline is the way I would describe it. We can grow by doing nothing. Our peers need to deploy capital, and they need to deploy increasing amounts of capital to grow. We'll find the right balance between, all the different ways we can allocate capital, which is dividend, NCIB, balance sheet, and growth.
Right. So I'm intrigued by the changing nature of the company's makeup. I'm talking about people who've come along with you, some recent appointments. It's all finance led. So, which tells me something that, you need to kind of get the house in order in a way. But at the same time, you're still going to need to understand, if you're going to do M&A, if you are, you're going to need people to be able to validate and check and go, these are good projects to be putting our money into. So is that all in? Is that still in-house, or is that now going to be outsourced?
Well, let me say this. We are going to do deals. Absolutely. Like, we are in the royalty allocation business. My point is, we're going to be disciplined about it. We're going to look for good deals. I mean, there's no shortage of transactions out there to do.
How do you do that?
Well, look, we did that last year. I mean, we did smaller transactions, but we added growth in the producing space. We added exposure to Island. We added exposure to Lamaque. We did a transaction with Regulus Resources, which is big optionality, long dated, but big optionality. In the span, in what we created with Osisko Development, we added 20,000 ounces of geos in time when those two assets are in production, rather than paying $500 million, which is the going rate for that, we got paid $500 million to take it. So I think we've done some things, but we'll invest in growth the way we always have. I mean, on our worst day, I think we're more technical than our peers are. I mean, you can't throw, a hand sanitizer bottle in the office without hitting a geologist or an engineer. I mean, that's the DNA of this company. The fact that we've split the team in two does not mean that we don't have access to the people in the company to diligence and run our business. And then also exposure to, if we need a specialist, we need a tailings expert. One exists, they sit a floor lower than us. If we need a metallurgist, there's one that we have a history with that we can go tackle. So we've got all the people in house that we need to do our work. And then we have, access to people around us. And then we can also go external to go use consultants. One of the things that shocks me in the space is how the over-reliance on external consultants, frankly. And again, anybody that knows the Osisko group knows that mining is in our DNA. I mean, if you don't think we have technical people, think again, that they exist. But the over-reliance on consultants has always shocked me. I mean, I think, we've been criticized in the past for carrying too big of a technical team. And I think they paid for themselves tenfold. Having that continuity of team, looking at all the opportunities you look at so you can compare and contrast, as opposed to hiring one consultant here, one consultant there, knowing the caliber of our team such that, we know the people that are looking at it. They've built mines themselves. These aren't people that are just doing desktop exercises. And when you use a consultant, frankly, yes, some of them are great and you can get the A team, but you can also get the D team. You can get, the last person to graduate in that class. And when you look at it today, I mean, with how hot the sector is, the intensity of projects moving forward, these consultant firms are the first people to get poached in terms of their people, and they're moving back into industry in pretty significant ways. So, no, we've got all the folks we need in-house. We prefer to keep them in-house or close to us. If ever we need a specific expertise, we'll go get it externally. We always have, we always will. But that's not a problem for us at any point.
It is hotting up. There's a lot of new entrants in the marketplace.
There are, yeah.
There's some train wrecks waiting to happen in the marketplace. There are people creating competitive tension in the marketplace, and may cause you to overpay. So how do you stop yourself from doing that?
Well, I think if you look at 2020, the proof's in the pudding. We did stop ourselves from doing that. I mean, we didn't overreach for assets. And again, partly, I'm fortunate that I don't have to. I mean, I'm fortunate that the team spent so much on growth that we can rely on it. And it has to be, it can't be growth for growth's sake. Yes, we are in the capital allocation business. We need to allocate capital, but we need to do it at the right times in the cycle. And the royalty sector is a down market business model. You put more capital to work when people need it, and then you have to be willing to take a breather and benefit from your existing transactions when they don't. I mean, the biggest competition for us is not so much the smaller scale, the newer entrants that you're referring to. I mean, we have so much exploration development upside in our portfolio already that we don't feel like we get credit for. We don't necessarily need to go add that, or at least pay up to add that. When we find value, we'll take it. Frankly, we don't participate in too many auctions for early stage assets. If we tack on early stage exposure, it usually comes through our technical trap lines. Back to the earlier comment, I mean, we have got so many geologists that have kicked rocks around the world. If they've got a geologist buddy that finds something, we're liable to get the first call. So that's how we tackle the back end or the early stage portion of our portfolio. The competition really is from equity and debt markets. It's, because the bigger players, the people that can deploy real sums of capital is the same, really has been the same for some time. So what you're competing with is equity and debt markets, and that's frankly completely normal. That's what happens in these points in the cycle. So you have to be willing to bide your time. And there's certainly a lot of opportunities out there, certainly a lot of people wanting to sell streams and royalties. That doesn't mean we should be there, to catch some of those babies. So I think it just comes back to balance.
Cash is cash. And there are lots of options in a market like this for companies, for sure. Do you think that's going to change the shape of royalty companies going forward? Or are you going to have to think of new ways of competing?
Well, we've always had newer ways of competing. So sometimes it's worked, sometimes it hasn't, Matt. So I think for us, we're happy with where we are today. There's a lot of value in the portfolio. And we want to stay in that lane. It's taken a good amount of work to get us back in there. So don't try to tempt me too much, Matt. But the truth is, there's always ways to allocate capital in this business. It's a capital intensive business. There's always new stories as the gold price picks up. Certain new projects get greenlit. So we're always going to find opportunities to deploy our capital. They just have to be the right ones for us.
Okay, let's talk about cash flow. What's your cash flow now, and what's the growth profile look like?
Sure. So at 80,000 ounces this year of GEOs, if you take a current gold price assumption at 97% margin, mind you, because we have more free ounces than cheap ounces, more royalties and streams, that should spit out about US 130, 135 million of cash margin to us. And from that, we pay our dividend, we run our business, and everything else is discretionary for growth. And as I said, we've got growth assets. So another 6,000 ounces coming from Mantos alone next year, other things that are coming down the pipe. So, excuse me. The point is better than peer average growth for the next 4, 5, 6 years.
What does that look like in terms of reserves only basis versus resource? And what I'm trying to work out is how much are you attributing towards exploration?
So maybe I'll answer that differently because, again, I don't have that number at my fingertips. But the point is our producing assets are growing on a reserves only basis. They're also growing on a resource basis. But the reserves underpinning our assets are also being extended significantly, grown and extended significantly. So our production base is very sound. I mean, when you think about it, and it's not rocket science. When you think about Malartic, in terms of what's happened there on the underground, that goes straight to the bottom line. Eagle is a brand new mine. It's just commissioned last year. It has a full mine life ahead of it. Mantos, our project there, has a production profile out to 2035. Island is growing in leaps and bounds. The work that Eldorado has been doing at Lamaque is growing. They've added ground around them. All of that's on our royalty grounds as well. So when you look at the portfolio, there really aren't any short mine lives, if that's what you're driving at. And then on the resource side, obviously in this gold price environment, there's a lot of upside there as well.
I wasn't driving at that. I was trying to drive at how much of you attributing to long lead items like exploration, but I can drive at that now.
So sorry, let me actually answer your question then. No, look, those are ounces that exist.
Right.
Those are ounces that are on the books now in the reserve category. The growth is coming off of reserves and resources, obviously, but those are all real ounces that exist today. The upside would come thereafter.
Right. So now they drive at the thing that then, which is what is the duration of that cash flow? Again, reserve versus resource.
Yeah, look, I mean, I'd say there's very few short mine life assets in our portfolio. So we don't see longevity being an issue at any point. We've got 10 plus year mine life in all our core assets, probably closer to 15 on our core assets. Malartic is circa 20 and it's growing in significant ways. So no, we've got, we think, mine life exposure that matches the big three in the space, kind of, on a reserve basis around 15 year mine life. The resources are all additional upside to that. And again, I'd say, we're on some pretty important overall to the sector land packages that are always going to get that disproportionate exploration dollar. And so the upside beyond what's currently on the books is pretty significant.
Okay, let's talk about organic growth. And this is a tough one because you provide royalties and some streams, but you don't really have a say in what the company does or how it reports or what it focuses on at any one time. It's you are informed, but at the same time you can't give guidance on their behalf. Although some do try. Believe me, that's what I've learned over the last 2 weeks. In fact, it's been lucky enough to actually inform the company of how many ounces they're going to be producing. Yeah, it's good news.
We try not to, but I guess.
It happens. So let's talk about organic then. It's a young-ish company. I don't think you're going to be able to claim that for too much longer, even though you're new. What is the organic track record here?
Well, we talked about it earlier. The organic track record is significant. I don't know of too many other companies. Yeah, we're young-ish. We're a teenager, I guess, if you want to use an analogy, but I don't know too many companies that can tell you that they have the assets bought and paid for that will double their production. And in a significant way. Obviously, there's startups that are moving up and some of them are doing a much better job than others. But you can grow at that kind of pace when you're when you're a $50 million company or a $100 million company. But to be a $2 billion US market cap company and say that we already have the assets bought and paid for to become, a 2x of where we are today. And just based on development, various stages of feasibility or studies, feasibility and construction, not looking at the back of the cupboard where all the exploration assets are, some of which are getting significant work. That's pretty significant organic growth, I think. So we think it's peer leading, frankly.
Okay. And I suspect I know the answer to this, but I'll ask it anyway because you weren't able to answer earlier. But if I look at your organic profile for development companies, companies that are in development will be in production in the next 2 years. You kind of talked loosely around that one. Do you think that there's going to be any additional organic component contributed by them in terms of other work within their portfolios? I mean, how do you get a sense of the size of the opportunity ahead of you? I guess what I'm trying to get at.
Absolutely. I mean, those companies are not standing still. So they're getting better, they're getting bigger all the time, or they should be if you've chosen correctly, and I think we have. So again, to stay, in the family, if you will, Barkerville in 2019 had 4.4 million ounces, give or take. They currently have 6. You spend $20 million US in exploration at Barkerville, and you get 1 million ounces, half inferred, half M&I. Until that stops being true, Sean's not going to stop doing it. So the upside there is significant. There's an 80-kilometer camp, or two strike lengths that make up 80 kilometers of trend, and that will continue to provide a ton of exploration upside, we think. Osisko mining, again, in the family in Quebec now, high grade in Quebec, that's at 6 million ounces, and every drill hole adds. So the point is our development assets are growing all the time. I think the growth there is nice. We'd like them to continue to grow. The most important thing they can do for us is get into production because they already have long mine lives. Obviously, we expect them to continue to add to that, maybe get bigger from a throughput perspective. But the biggest component of value that can derive is just getting into production, because we just don't get real value for development assets until they're producing.
Right. Okay. I mean, I had a bunch of questions around that, but I think that we'd be saying the same thing. We'd end up talking about the same stuff, but I'll leave it. So looking at producing assets, the organic component, which we kind of danced around there, I think, as well, and transactions, we talked about loosely. Do you have a view in your head about 2021 as a percentage of your value, what that looks like today and what you want it to look like at the end of the year? If you had to break it down.
How much we might spend this year, you mean?
No. This is specifically about, right, today, you're undervalued against your peers. You've told me that. And I think, well done. You need to say that. You've done it.
Yeah.
But therefore, you've got a view today of where you think that value lies within the portfolio of companies. So what do you think? Do you think that at the end of this year, that will look pretty much the same? Or do you think that you are going to try and shape it differently and try and maybe create more value from sort of the rest of the portfolio?
Look, I think the portfolio, I mean, the biggest thing, honestly, I can do, or we can do as a group, is to get out of the way of the portfolio and let it speak for itself. I mean, Malartic, the fact that we're still trading at the same share price as we were before the Malartic underground construction was announced is a bit of a farce. So, that's a huge amount of value. The fact that we're trading just based on, I mean, you can zero, we own $1 billion of equity, by the way, we didn't talk about. You could zero that out entirely, and we still, because as I mentioned earlier, we're still trading at the lowest price to cash flow metric in our peer group. All that is current operating assets and current market cap. So that ignores that 50% development weighting. It ignores $1 billion of equity. So I think, who's to say where that value will come from? But our point is we want to unlock it, and I think we're on the right path to doing that.
Well, tell me how. Because we've talked about a bunch of stuff, and if I'm listening as a retail or family office here, I'm trying to break it down in terms of what you, the new guy here, I know it's October, it's still newish, is actually going to do, and when those things start to take hold and take effect and actually just change that course more significantly. I need an inflection point.
No, it's funny. And you're right. Inflection point is an interesting question to ask and a way to phrase it, because I don't think there is necessarily an inflection point needed. which is a bit of a weird thing to say. I expect all this value without doing something, significantly different. And the reason for that is I think we had that inflection point in October. We spent all year with this cloud above us, which was, the company's a hybrid. There's CapEx risk, there's OpEx risk because they're going to go build Barkerville because Sean is at heart a miner and he loves the asset and he's going to do it. And it doesn't matter what he or Sandeep say, that's what's going to happen. And the way we resolve that is, now the answer is Sean is a great mine builder and he is going to build it and he's going to build it here and he's going to finance it here. So I think that was the massive catalyst. Anyone who's looking at us now should not hopefully see complexity. They should see a significant royalty company with royalty assets that matter, a lot of growth that's paid for royalties and streams. And by the way, we own $1 billion of equities in other public companies, and we will take money off the table and reallocate it towards our royalty business. To me, that's not overly complicated. I think, the passage of a little bit more time convincing people that need further convincing that that's the case, staying on point and on message, maybe taking some money off the table as a last proof of concept that we are money off the table. I mean, on that equity book, on Osisko development in particular, and proving that we have separated that church and state is really the only thing left to do. And outside of that, I think the royalty portfolio will provide the catalyst on its own because it is. We cannot direct that portfolio. We've built one that matters. It's important. It's good assets, good operators. Letting them do their work and benefiting from it. That's what's going to unlock this value. And then if we can add to that incrementally, which I think we will on external growth, great. But we don't need to get to where we think we're going.
But isn't that part of the problem, that separation of church and state for you guys? Because having been miners, got into the royalty gig, took a few wrong turns along the way, and you're trying to talk to me about this pure play message, this cleaner communication in the marketplace. Wouldn't it be better for you if you did take away that relationship or perceived, relationship with the mining component and, cash in some of those equities?
Well, it is. I mean, the relationship is, divorced. Obviously, there's a lot of overlap, but there's a mining team building assets within Osisko development. Excuse me. There's a royalty team, and we had all the people in house to staff both, which obviously also resulted in a significant reduction in G&A and a streamlining of the company. But that's aside, we have split the company. So on the asset side, Sean is running that company, creating value. I'm running Osisko Royalties, creating value, hopefully within our royalty business. The equity portfolio, it is the only kind of question I get left, Matt, is when will you reduce? How will you reduce? Again, frankly, we're not too descriptive as to when and how, but we have said that we will, and that's the last piece of the puzzle. If that's the last proof of concept that's required, we'll provide it. But ultimately, again, you can zero that out, and we're still trading cheaply. So I see that as an asset. I don't see that as any kind of liability.
But I do want to talk about multiples and so forth, and whether the rest of the industry is being valued. I do, but I just want to deal with this some more because
sure.
There's a kind of muddying of. I get that you've separated out, and Sean's gone to do mining, and you're in charge here on the royalty bit. But in people's minds, the perception, the optics in the marketplace is that it is the same thing. You're using some of the same people, and therefore the decision making becomes grey and not clear and not concise as you want to be with the marketplace. Is there danger of that?
There shouldn't be. Look, I mean, perceptions matter, and so I take your point, and we're working on combating those perceptions. I think we've been knocking down one after the other for the last year and a bit. I mean, anybody who had said to us, or if I had said to you in January of 2020 that there was that much value to unlock in Barkerville, and Sean was going to be running a mining company by the end of the year, I was going to be running the royalty company. Mind you, I just come in as president in January 2020. I think you probably would have said that's a load of BS, but that's exactly what we did. So we have created a lot more separation than I think people would have given us credit for at the start of 2020. Continue on that path is a lot easier than what we accomplished last year. The way we completed that transaction in October and December of last year was significant for us. Continued, steps along that path are just going to happen with time. If people need to see them to believe them, then that's fair enough. But I don't see that as any kind of real risk to how we're running the royalty company at all.
He's the chairman of your company, right?
Yeah, no, and he's the founder. I mean, he's an important guy. I mean, we wouldn't have a 5% royalty on Canadian Malartic if he first hadn't built the mine, found it, built it, sold it, and structured the royalty. So, and there's value in Sean being chairman of our company. The greatest value he can create for us is on Osisko development in terms of putting those mines to production.
But he doesn't need to be chairman of your company to do that, is my point. You know, he can still be a big shareholder. He is the founder. I get all the history.
Yeah.
I'm talking about clearing up the confusion in the marketplace, because you've got, as you say, you've done a lot of things to change this, to make it better, to turn the ship around, as it were, and compete in this marketplace as a real royalty company. Do you not think that would be quite an important piece to sort out?
I don't particularly. I mean, look, the truth is none of these group of companies exist without Sean. He's created an awful lot of value in the space, in the sector. There's an awful lot of people that see him as an asset. I'm one of them. There's an awful lot of people that want to work with us because it comes with the Sean Rusin factor. So in the mining space, the people that we're trying to allocate capital to, they certainly see us as a partner of choice, and Sean's part of that. So I see it as an absolute asset. And look, I mean, he's focused. His day-to-day is running Osisko development. That's and look, he is energized in doing it. You know, the people that had the view that he's really a miner at heart and that's what he likes doing. There's a fair bit of truth to that, and he's doing a really good job of knocking geologists and mining heads together and getting the right answer. He's behind the scenes on Osisko Royalties. He's there if I need a sanity check on a certain asset, a relationship with somebody in the sector that he's crossed paths with, and that's what that's what your board and your chairman should be there to do. Okay. So it's no different than anybody else, really.
Maybe, but you've got a very different recent history. So that's why I asked. That's why I've been asked. I've been asked this question a lot. People do think about it. People do talk about it, and I want to know you've considered it and then made a decision, and that's fine. But if it's no, we'll just carry on as usual. Don't worry about it.
Well, I mean, I'll say this: the point is a fair one. I mean, our recent history is muddy, and that's at least in some people's mind. Not so much ours, but what we think doesn't matter. What people think of us matters. And I think if you take a step back and you look at what we've achieved in the span of a year and a few months now, it's frankly exactly what we said we were going to do when we announced that transaction. Created a lot more separation than I think anyone would have given us credit for. So we're hopeful, and I firmly believe that we'll get credit for it. Can we continue down that path? Sure. Again, that transaction was announced in October or closed in December of last year. So got to walk before you run, but I think we've been walking towards, and frankly, hopefully jogging towards a pretty good outcome here.
Okay. What are you trading at versus your cash flow?
As I said, sorry, I didn't give you a number. I think we're trading at about 13, 14 times cash flow right now.
Right. Do you think that's reasonable and sustainable?
It is it's the lowest end of our peer group. We've traded higher in the past. It ignores the entirety of our development weighting. It ignores $1 billion of equity investment. So I think it's certainly sustainable. On a price to net asset value, we're trading about 0.8 times consensus NAV, and we're covered by 15 brokers, pretty much everyone who covers the mining sector. That's not always been the case. I mean, we're trading like a development company right now, so it is pretty ridiculous.
Yeah, at times you're trading like a mining company.
Well, worse, trading like a mining development company. So that's the challenge at hand. It's one that we firmly have a handle on. And again, as I said, weird to say, but genuinely believe that we don't have to do too much different to get to a better outcome. A little bit of further simplification, maybe the pursuit of boredom, I like to call it internally, and letting our assets speak for themselves, I think will go a long way.
What's the payback time?
What do you mean by payback time? I want to make sure we're not getting lost in translation.
Right, as in you've spent a whole bunch of money so far. I get the 1,000 in security, etc. So at some, I know you've got zero debt at the moment. Is that true?
No, that's not true. We have, just to answer your question specifically, we have a 400 million Canadian in debt, 100 million plus on the balance sheet in cash, an undrawn credit facility to do with for growth, whatever we choose to, and that $1 billion of equity. So on a net cash basis, if you add the equities, which I admit are not liquid today, but the intent is to chip away at them, we're definitely very net cash positive. if you're asking me when's the payoff, so to speak, which is maybe more North American jargon, I think this year. Like, I think we did all the right things last year. That was the reset year, as I called it. We have to get value in the portfolio this year. We owe it to our shareholders, and we will do everything in our power to do that.
Brilliant. Sandeep, appreciate your time today. Nice run through. I know we've spoken with Sean previously, but it feels like a new start. So I wanted to hear it from your lips, your version, and get a view of how you see the future. So appreciate your time today. Stay in touch. Pick up the phone when there's something to say, okay?
Absolutely. Thanks for your time, Matt. Always good to talk to you.